Right? Economic output, total factor productivity, capital, and labor. If we're going to do this in a non-mathematical way, that is, if we're going to do this graphically, I need to do it in only 2 dimensions. Maybe you're good at drawing 3-dimensional diagrams, but I'm not. So notice that if we're only going to draw in 2 dimensions, we can only put on the axes 2 of these 4 variables, which means we have to make an assumption about the other 2 variables. And so the assumption that we start out with, which we can relax later, but the assumption we start out with is those other 2 variables are going to be held constant at some given value. Right? So if we were to draw this for real, we'd have to know what those values would be. So the first relationship that we're going to look at is going to be the relationship between economic output and the capital stock. And that means we have to have a given labor force and a given level of, total factor productivity. Okay, I don't know who did these slides. Okay. So a given level of total factor productivity. That's why I've put this subscript 0 or not on here to indicate that those are a fixed level at this point. So what would this look like? If we draw this, we want to put economic output on our vertical axis and the capital stock on our horizontal axis. This production function will have a shape that looks something like that. Okay. So economic output equals our given level of total factor productivity times some function of the capital stock and a given quantity of labor. Now notice what this says. If the capital stock is fairly low, say at K0, then the level of economic output will also be relatively low. Why not? If we have more capital, then with the same level of total factor productivity and the same quantity of labor, we'll be able to produce a much higher level of economic output. So that's the first feature of this production function. It is a positive relationship between economic output and capital stock, which tells us that we have increasing returns to capital. As we add more and more capital, economic output will go up, up, up. This, by the way, is true for an individual business firm as well as for the economy in the aggregate. There's a second feature here as well, and that is if we pay attention to the slope of the production function, what we see is as we add more and more capital, the slope of the production function becomes flatter and flatter. Now, the slope of the production function tells us how much additional output we would get from a small increase in the capital stock. So again, what it keeps telling us is as we add capital, yes, output goes up, but eventually the output starts going up by smaller and smaller amounts. This is something we call diminishing marginal product of capital. The diminishing marginal product of capital. As we add capital stock to a fixed level of total factor productivity and quantity of labor, output will increase, but eventually at a smaller and smaller increment. So that then gives us these 2 features, right? Increasing returns to capital and diminishing marginal product of capital, where the marginal product of capital is simply the change in output brought about by a small change in the capital stock. We can also chart the marginal product of capital, and we would see that it falls something like that. Okay? So again, notice when the capital stock is relatively low, the slope of the production function is relatively steep, and the marginal product of capital will be relatively high. When we have a lot of capital, the slope of the production function will be relatively flat, and that means that we have a much lower marginal product of capital. Now, knowing that, the next question we want to ask ourselves is, suppose we're running a business. And we know that if we add another machine, or 2 machines, or 3 machines, we can produce more output, and we can sell that output, and that'll give us more revenue. How do we decide whether it makes sense or not to add 1 more machine, 2 more machines, 3 more machines? How do we make that decision? So notice, adding a machine is going to increase output, right? And it's going to increase output by the marginal product of capital. And we know we can sell that at whatever the current price is, and that means that we can figure out what our revenue is. We can measure the marginal product of capital, we can determine what our revenue is. That's the benefit from adding a new machine. But we also have to think about the cost of adding that new machine. So we know what the revenue coming in is, but what's the cost associated with that? When we're talking about capital, physical capital, we do not think about the purchase price. Remember something that we said on Tuesday, capital goods have a long life associated with them, 3 years or longer, in most things more than 3 years. So what you really want to figure out is what would it cost you to use that machine, or that factory, or whatever it is that we're talking about, for 1 year? And this is an expression that we refer to as the rental cost of capital. The rental cost of capital, R sub C. I've got to put the sub C because we're already using R for interest rates. Right? So R sub C will be the rental cost of capital. So an easy way to think about this is, instead of buying a machine, what would happen if you went out and you rented it? Or you leased it from somebody else? Right? What would they charge you? That would be what your cost would be. Even if you bought it, you could think about, well, geez, what happens? I need to borrow the money, and I need to make some payments on that over the course of a year, maybe something against the principal as well as the interest rate, and that would tell us, again, the rental cost of capital. So it's easiest to think about it as the rent or the annual lease cost of this piece of capital equipment. So that's our cost side. All we have to do then is to think, wow, we know what our revenue is going to be from the marginal product, and now we know what our cost is going to be. Let's just compare the 2. Right? If our marginal product of capital is high, then high relative to the rental cost, then we would want to add another piece of capital equipment. The demand for capital would also be high. As the marginal product comes down, fewer machines or factories or physical equipment now really become profitable relative to the rental cost. So the demand for capital will also be weaker. So in equilibrium, we want to think about adding capital as long as the marginal product of capital is greater than the real rental cost of capital. We get to equilibrium when they're exactly the same. If the rental cost of capital is above the marginal product of capital, we'd like to get that capital off our balance sheet, off our books, sell it, get rid of it, break the lease. Right? We're not bringing in enough revenue to cover its cost. So we end up then with an equilibrium condition, and we also end up with the marginal product of capital essentially being the same as the demand for capital. When the marginal product of capital is high, there will be a big demand for capital. When it's low, the demand for capital will be weak. And as a simplifying assumption, we're going to assume that the supply of capital is fixed. And this actually isn't such a bad assumption in the short run. It actually turns out the supply of capital does not change much in the short run, for reasons we'll look at later. So if we wanted to diagram this, which of course we do, this would be our capital supply at a fixed level, and our capital demand would equal our marginal product of capital. Notice here, at the intersection point, the quantity demanded equals the quantity supplied. We should get the equilibrium price. We'll call that R sub C naught. That's my version of a lowercase r. It's okay if I have terrible handwriting. I'm a doctor. Unfortunately, you're not a pharmacist, so you can't read it, so I guess I'll have to tell you. That's a R sub C naught. Okay? So that's our equilibrium rental cost of capital. So in a competitive market for capital assets, the price will be set by supply and demand, just like in any other market. Now notice that if, for some reason, the rental cost was up here, we would then have excess supply and again, in a competitive market, whenever you have excess supply, market pressures will force the price down. As the rental cost of capital comes down, the quantity demanded of capital will increase along the demand curve until we get back to equilibrium. Just the opposite is the case if the rental cost was below its equilibrium value. Now here we've got excess demand. In a competitive market with excess demand, market pressures will force the price higher. As the price rises, the quantity demanded for capital will decline until we get back to equilibrium. So as long as we have a competitive market for capital equipment, we shouldn't be away from our equilibrium price, at least not away from it for a very long period of time. So this is our diagram that we've just constructed. Notice here we have a production function on the left. And this production function is the function looking at output and the capital stock. And on the right, we have the capital market. So keep in mind, when we talk about the capital market, we're not talking about financial capital. We're talking about physical capital. And now we've got equilibrium. As long as we're at this point, we know what the rental cost of capital will be. The stock of capital, we bring the stock of capital over to our production function, which tells us economic output, which in turn tells us how much, capital stock, which in turn tells us how much economic output we're producing. There's one other thing that this diagram shows us, and that is how much the capitalists are earning. Remember national income, if you remember all those categories, which you probably don't, remember, a national income is employee compensation, how much do the workers get, and corporate profits and non-corporate profits, and then a bunch of other categories, which tells us how much businesses are getting. Well, capital is almost always owned by businesses. And even if it's owned by an individual, that person is considered to be a capitalist, right? The term capitalist, whether you think it's a pejorative or not, really means the owners of capital. So if we want to think about what share of national income goes to the owners of capital, it's simply how much are they earning per unit of capital times the number of units of capital there are. So the product of these two tells us how much profits or return to the capitalist is being generated in the economy. Now remember, when I use profits, it's not just corporate profits, but also non-corporate profits. Now remember, when we drew our production function, we said that we wanted to hold the labor force and total factor productivity constant. Right? That's why we have those A naughts and L naughts. So let's suppose that one of those changes. So let's suppose for some reason there was an increase in labor. So rather than at L naught, we're now at L1, some higher number. What should happen? We have a given amount of total factor productivity. We have a capital stock. If we now add more workers, what we should be able to do is generate more output. Right? So each piece of capital should now be able to produce more output because each piece of capital is now worked more intensely. So if this is our capital stock, K bar, we should now be at some point up here, Y1. Now that would be true for every level of capital. K bar is just the one we identified on this axis. But it's also true that if we have no capital, we can produce nothing. So we have to start at the origin. And what's happened here is the entire production function has rotated higher. So this is not a shift in the production function. It is a rotation of the production function. Because if you have no capital, you'll have no output. So you're always stuck on the origin. Yes? What do you mean if you have too many people? Hard to imagine that in a country. You can have too many employees in business. It's hard to imagine that you would have too many workers in an economy relative to the size of the capital stock. Okay, so now you have to ask yourselves, what happens to the slope of the production function? The slope of the production function, right? The production function rotated higher. So in fact, the slope of the production function becomes steeper. Okay? Now, maybe it doesn't show up all that well in the way I've drawn it, so let me, whoops. Easier to see that the slope has gotten steeper? Okay. So as long as we're rotating as opposed to shifting, the slope of the production function will get steeper as we move higher. That is, as the production function rotates higher. What does that mean? It means the marginal product of capital has increased. So in this case, where the production function rotates higher, we also need to shift out our marginal product of capital. That's caused by the shift in the production function. Right? So if you add more workers, you're producing more output. Now notice that at this original rental cost of capital, we now have excess demand for capital, which is going to cause the rental price to rise. To get us back to equilibrium at this point, call this point B. Now we're back in equilibrium. Because we assume that the capital stock was fixed, there's still no change in the capital stock. But notice that the rental cost of capital has gone up. Now you might think, well, wait a minute. We've got more workers. Why does the rental cost of capital go up? So remember, we've got that production function. We've got one worker for one machine, as an example. Now you're hiring more workers. Guess what? Eventually you're going to want more machines. So as the demand for more machines goes up, with a fixed supply, means that the price of machines, the rental cost of machines, will also rise until we squeeze out some firms from wanting to have more machines. Okay. And notice that again, the share of national income going to, well, income has gone up. It also looks like the share of income going to the capitalist has also increased. I shouldn't say the share. The amount going to the capitalist has increased. Until we know the magnitudes, we can't say anything about shares. Okay? Now, what causes the demand for capital curve to shift? There are only two things in this model. We can have a change in the labor force, which we just showed, or we can have a change in total factor productivity. Either or both of those would cause the production function to rotate, changing the slope of the production function and causing the marginal product of capital to change. Now, let's think about the other way we could look at the production function. Rather than looking at it in terms of output and capital, let's think about output and labor. Again, when we do this, we have to have a given level of total factor productivity and a given capital stock. We'll put economic output on the vertical axis, the labor force on the horizontal axis. Our production function between output and labor looks something like this. Oh my goodness, it looks almost like the other one. And because it looks like the other one, we can see immediately two things. One is there's increasing returns to labor. As you add more workers, you'll get more output. Second, there are diminishing returns to labor. As you continue to add more workers, output will rise, but eventually at a slower and slower and slower and slower pace. We have diminishing marginal product of labor, right? Because each worker is now having to share more and more machines, more and more total factor productivity. So we get the same conclusions that we had from our earlier one, although this time with labor. Now the other thing to notice, one of the things that this diagram tells us is if labor is changing, the number of workers is changing, right, up and down, what we'll also see is a movement along the production function, so economic output will move up and down. Now while the capital stock does not change very quickly in the short run, the labor input, the number of employees, can. And in fact, that's what this chart shows. This is the year-on-year growth rate of the number of employees and the year-on-year